Hello everyone, Steve Lentz here with Discover Options. Welcome to the Inside Wire. It is November 14th, 2017. Presented material is for educational purposes only. It should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. And that especially applies for today because we're going to do our annual credit spread study update. We have a free ebook that we offer folks that tee off on this study that I started looking at this, gosh, well over 10 years ago, and just as a trading system, and it really is pretty phenomenal. We call it the RSI Credit Spread Approach, the Discover Options RSI Credit Spread Approach. So we're going to review it, and then we'll do the updated study to show you how well it is performing and performed this last year. All right. Bottom line is there were no losing trades over the last year, as you'll see. So let's go right to it. Okay, so just as an overview, this is a credit spread approach, and we do it in the Russell, and it basically uses the RSI indicator to then time the entry of bull put spreads or bear call spreads. All right, and so this is, and it's the previous ones have been, the previous updates have been posted on the archive, but let's go over it. And I think you'll find this very intriguing here. So in the world of technical analysis, the premise that we're dealing with here is that when a trend is about to end, okay, and finish up, we're going to sell option premium just over a standard deviation out of the money and then challenge the market to move that far. Okay, so that's kind of where we're headed here, is that if the Russell index is trending upward and it's showing signs that it's about to finish up, well, then at that point we're going to go ahead and sell premium a standard deviation out of the money in the calls and challenge the Russell at that point to yet get a further set of legs and go a further standard deviation yet again to the upside. And we're using the RSI indicator as a way to time the notion that it's very unlikely for the market to yet continue again for another standard deviation to the upside. And the same holds true for the downside. Okay, so when is a trend about to end? So we're going to look at the RSI as the main indicator that we use. I'll go over what it is, the trading signals that it generates. We'll go over a trading plan. I'll show you a few trades just as an example, and then we'll look at the results. What is the RSI? Okay, that's the relative strength index. It was promoted, well, it came out in Wells Wilder's book, written in the 1970s. You can still get this. And I have my copy. I ordered it on Amazon years ago. And in that book, you have other concepts that are just a standard part of most charting programs. The ADX, the Directional Movement Index, you have average true range, the RSI, and some others that are just have been very, very important in the world of trading and teeing off on. And he did it without computers. It's all spreadsheets, as you'll see in the algorithm that he uses for the relative strength. Very interesting. So here's the algorithm for the relative strength index. It's basically a smoothed average of a ratio of the average gains over a certain number of periods, and 14 is the default typically. The ratio of average gains to average losses. Okay, and then that figure, that ratio is normalized, so it's scaled between 0 and 100. So here's just an example. We'll take a swath of time here in the Russell, and let's just take a glob of bars and take a look at these. And what he's doing is we're looking from close to close. Now, the ADX and the directional movement indicator, tee off on the highs and lows and the relationship of the close and to the highs and lows and all that. This is only looking at the closes. So over the 14 days, you look at those days where you had higher closes from the previous, okay, and the average gain amongst those is 8.58. Then you take the losses, those days that had a loss, and the average loss for those days. In this case, is 13.6. Then you have the ratio. Okay, let me see, did we do it? No. Then you take the ratio of those two, and you have the average gain divided by the average loss. That's the relative strength. Then you plug it into this algorithm, and basically what you have then, and what he did to get his averages, and I don't want to get into it here, but basically when you get his book, you'll see that he had a way of calculating the average so that he could quickly do it in a spreadsheet form. He, every day, one day would come, one day would go, and he would just basically, carry over a previous column and that kind of approach, so that he saved a lot of time. Basically, he would not have to recalculate the averages by hand every single day. He had this carryover approach that made it quicker. And you can get the book and take a look, but it works out real well. And it ends up having then an oscillator here between 0 and 100. And generally, you'll see that the indicator flows with price. Okay, generally, not always, as it becomes very important. You can see here that generally as price meanders its way up and wobbles around, you have the relative strength index, the RSI, kind of doing the same pattern. Now, this has been, there's whole trading systems based just on RSI. This is one of them, but there's a lot out there on this. And I don't need to tell you. I'm sure you guys, can find it and Google it, and you'll get just a ton of material. But generally, the signals are carved up into 2 or 3 different categories. You have overbought and oversold signals. So when the market goes really, really low and is in oversold territory and then turns up above 30, okay, that's a sign to consider a bullish direction. If the market goes way above 70 and then turns down below 70 from that overbought territory, that's a signal to consider a bearish position. Okay, so again, for bullish, when the when the RSI comes down and then curls up above 30, okay, that's a sign to go, long. On the bearish side, when the price goes up and up and up and then turns down below 70, that's a sign to consider a bearish position and go that direction. So that's one way to do it. Now the other way, and we're going to look at this ourselves here, is you have divergences between price and the indicator. Now, I'm only going to show you the direct divergences. There's also something called hidden divergences. But basically, when price makes new lows and the RSI fails to make new lows, that's when you want to consider a bullish position. Okay, and we're going to look at an example. And then on the bearish side, when price makes new highs, and we're looking at price first on these. You look at price first, making new highs and lows, then you go to the RSI to see if it confirms or not. Let's just take a look at overbought and oversold signals, just like this. When the market goes way down, goes below 30 and then bounces up above 30, look at that one. That was a pretty good one right there. When RSI climbs above 70 and curls down like it did there, you got a little bit of a pop downward. But these signals don't happen that often. You can just see in the course of a year how often you get these kinds of signals. Let's look at another type. That's the divergence approach. This is where we're looking at price first, and when price makes new lows, like it did here, price went down below this low. You then look at the RSI and see if it similarly made new lows, and it did not in this case. And that's when you want to consider a long position. In this case, the market was trending down, 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 and then it made a new low yet again, but the RSI is not confirming that move downward. It failed to make a new low, and that's when we're thinking, the momentum is really waning on the downside here. Maybe it's now run out of gas to the downside. Then on the next up close, that in our case for the credit spreads, that's when we're considering and putting on our in this case it would be a bull put spread. Now just as an aside, there's something called hidden divergence, and that's where you, let me change colors here. This isn't part of the normal presentation, but let me, I just want to give you a, because I just thought of this today. I thought, oh, it might be interesting to kind of consider maybe looking at a hidden divergence. All right, let me take red here. Okay, so what we do is we look at the RSI first, making new highs or lows. So here we see RSI coming up, making a new high. So we go, aha, it's making a new high. Let's go look at price to see if it made a new high. And in this case, price failed. Okay, it failed to make a new high. And this is usually done in the context of the broader trend. Market's going down and down. RSI has a new high coming up. Price is failing to. This is a sign that this pullback is now complete. Now that the RSI has made a new high, the pullback is complete, and now on that next close on the downside, we would consider a bearish position. That's teeing off on the what we call hidden. That would be hidden bearish divergence right there. But we're focusing on the direct divergence beginning with price. Let's look at the bearish side. Price is making a new high here. Okay, trend is up. Price is making a new high. We come and look at the indicator and we see that it's failing to make a new high, in which case on the next down close, that's when we consider our bearish position on the close of that bar. Okay, now let me see if there's any, I don't see any immediate hidden divergence that I can tee off on. Well, yeah, I don't know how well this followed through. Do you see hidden divergence? We're just kind of taking it at a kind of an advanced level here, but that's okay, because hidden divergence can work out very, very well itself. Here you see price making a new high here. See that? Okay, and we come down to the RSI, and did it make a new high? Well, it did. It failed to. Okay, and then in this case, the signal could be, you know, the next down close. All right, so, but that's in the context of an uptrend. Yeah. No, prices, we're going price first. Price making a new high, RSI failing to. That's direct divergence. I don't see anything where RSI is well, here's one. I mean, RSI from here to here, you know, but you got this one in the middle. I'm going to just abandon that line of thought, okay, and we'll move on. So here's the trading premise, all right? When a trend is about to end, we sell option premium over a standard deviation out of the money and challenge the market to move that far. So, what we're going to do is go a standard deviation out, sell premium, and challenge the market to hit that short strike. Now, if you did that, how often will an underlying asset, on average, touch that strike price that lies just outside right at, let's say, right at a standard deviation out there, assuming that the volatility input is the same volatility that actually comes about if they match up. Okay, how often? Well, when you run the numbers, you're looking at roughly 1 time in 4. Price will hit a standard deviation out of the money, assuming the volatility of the market is the same as the volatility input on that standard deviation. 1 time in 4, right around there. It depends what. I mean, here you were at 27% instead of 25. There's other calculators that have it just under 25, but that's just kind of right where it's at. So, if we were to do this then, okay, by trading against an exhausted trend, we seek to improve upon that 1 in 4 statistic and we thus expect our winning percentage to be greater than 75%. If we're under 75%, well, we could flip a coin and do better. I mean, right? I mean, if the two volatilities, the input and the realized, are the same, all right, you would expect the strikes to get struck one time in 4. Each, 75, so we're trying to beat that 75. Which options trading strategy allows us to apply this philosophy? Well, we could sell naked premium out there. We're going to look at credit spreads, though. And here, this is an old screenshot. It does a great job and you guys are advanced traders. You don't need to know, you don't need me to walk you through this, how to read the screen and all that. But I just pulled the screenshot because this is what we use to go over credit spreads. But basically, we take the spread, we come out of the money, we look at that spread, and we have two ways of making money on that spread. Time going by, you could just see that same spread out at 65 days, coming to 37 days, going to 9 days. You could see how that spread goes from 450 to 350 down to 65 cents. So time benefits the position, as does directional. We could take a 25-point spread, and when the market moves 25 points, you can just see the spread go from 350 to 230. If it happened in one day and the vol stayed the same, you could see you'd make $1.20 on that spread. So you got direction and time working in your favor. All right, that's, hopefully direction works in your favor, but you also have time as a benefit as well. And of course, this is a picture of the credit spread, and we usually go over the pictorial version of what I just showed you. Here are the trading rules. Okay. Okay, and so on the bullish side, let me switch colors here. On the bullish side, all right, we wait for a divergent condition where the index makes lower lows, okay, while the RSI fails to make lower lows. Okay, so we wait for that divergent condition to appear. Once it appears, okay, we then wait for an up close, and that'll mark our entry point as the close of the next day where we have an up close at that point. And what do? Well, we go out a standard deviation. We use the at-the-money call, implied volatility. That's what we were doing back then. Since then, I think we could refine it more, but I'm not going to go down that road. I'm just going to keep looking at this study because this is what we teed off on, and you could vary it between the call and the puts, have one volatility input for the calls versus one for the puts based upon the vertical skew and all that. We're just going to keep the study the same, use an at-the-money call IV, and go out of the money that far. We'll go to the first month that has over 21 days remaining. We're not looking at weeklies. We're going to the first month. And then, because I started doing this before the Russell had weeklies. That's when we started looking at this thing. We want to make sure we're going to get a 5% yield or better on this. So if vol is really low and we can't get a 5% yield, well, then we'll pass. We'll pass on that. And then we keep the trade on until it expires or until the market touches the short strike. Real simple. Doesn't get any more complicated than that. Now, certainly, there are best practices, and you would want to consider, if the market moves and you've made 3/4 of that spread of your credit within a few days, well, then absolutely take it off. But in terms of a hard-coded system, just to determine whether the system has an edge or not, we're just going to hold it to expiration, okay? But clearly, we all know that, if you have market exposure, when you don't really need to, occasionally it'll fire up and bite you. And then we just invert these for the bearish trades. Okay. All right. So now let's take a look. A couple trades here. We have price making a new high, the RSI failing to. We come out of here, out of the money in the calls. and sell a call credit spread that expired worthless. You see price went down and never came up and struck the 870, 880 call spread. Then in June, we had price making a new low. Okay, price making a new low, yet the RSI failing to. Then on that up close right there, we went down and then sold the 670, 660 spread. Way, if you come down here further, way out of the money, and indeed price then took off to the upside. So both of those were winners, of course. Okay, here are the hypothetical returns based upon our back trader. We'll take a peek here. We updated this from last year. There's been several additional trades. Probably, I didn't write down the additional trades we have. I want to say an additional 7 or 8 trades to make up from last year to this year, about this time. 77 trades total. 95% of them were winners. We had 4 losers out of 77. 73 winners, 4 losers. Okay, and you could see all the averages here. Now, get this, 2 of those losers were consecutive. Pretty brutal when your average loser is 2-3 times what the average winner is. So to have 2 losers in a row is pretty brutal on any trading system. But for this, with that kind of a ratio of average winner to average losers, to have 2 in a row, that means that you'd have to go about 6 trades to make up for that. Okay, which at 95% winners is probably okay. Here is the equity curve starting with $10,000, just keeping it, at 5 units, 5 contracts in the Russell, doing 10-point spreads here. And important points, we had in that time now I want to, the duration in the market too is important. You're in the winners were in for 37 days, the losers were in for 15. There were seasons where you just didn't have, you have these plateau periods where you didn't have a trade on. Okay, so keep that in mind too. You can't go several days, if not weeks at a time, without having any exposure at all to the market. But you can see, we had the drawdowns from those 4 losers sitting there, right there, there, and there, and 23.1% annualized return, and of course that's just holding the contract size the same, and not too bad. The max drawdown was 11.5%. So all in all, real good. It'd be nice to blend this with a trend following approach that would be complementary. Maybe, and that's what I thought of today. I thought, boy, trading at the end of these trends, looking for that direct divergence, it'd be interesting to look for the trend following hidden divergence trades along the way, and then you would have occasional condors on, that you're kind of swinging into from a trend following perspective, kind of like our directional movement credit spread approach, which I should probably update that study as well. Okay, I think that's it. No, and then I give you all the trades right here, all of them, A to Z, including the full spreads, and there you go. All right. Number of trades. Okay, so the calls, we had far more calls than puts. We had 3 of the put trades were losers. Only 1 of the call sides was a loser. And so it's you're kind of seeing a skew here. 2 of these came in a row, by the way. That was kind of an anomaly, I think. 2 of these 3, struck on a big down move. I don't know where the R is, average winner. 350, the puts, because you had some higher implied volatility on the put side. You had fatter profits there. Okay, so I mean, kind of the story is, I guess you could say you could focus on just doing the call side, I suppose. But you know, you also have fatter profits in the puts when those struck. Getting rid of that anomaly there with the two losers. That might have come in 2008. I'd have to go back and, well, here, let's go and take a peek. Those two losers came, yeah, look at that, October of '08. No surprise there, right? So if you take that out, I mean, you have just one loser in the puts here in, August, the summer of '15, which we know is quite volatile. So those can happen, of course. But other than that, you have a real good set of slippage and commissions. Commissions were set at $1 a piece, no slippage. $1 a piece, no slippage. And that's it. Okay. All right. Any questions, comments? We'll update this a year from now, see how it went, and I'm going to look at that hidden divergence possibility too. I think that's because I was seeing hidden divergence all over the place, thinking, oh man, it'd be nice to throw in another trade and have a condor on that you're swinging into. So I might take a peek at that down the road. Thanks a lot, folks. We'll talk to you next week. Have a great, beginning the holiday season coming up. We'll talk to you later. Take care. Bye-bye.